Hello guys, welcome back to ChannelForTrading. Today we are going to see more about option Greeks. This is the second episode of the weekend learning series all about option trading. In this episode, we are going to see these topics: understanding option Greeks, how option Greeks affect option premium, what will be the option Greeks for each of the four basic strategies. These four basic strategies we have discussed in episode 1 of the series, which was released last week. Those are long call, short call, long put and short put. Those are the four basic strategies which we discussed in the previous episode. So now let's see the first among the option Greeks. Try to understand what is delta. Before we begin, I want to give a disclaimer. These option Greeks are not so complex. You don't have to understand how these are calculated, but need to understand what it is and how this will affect the option premium. On that basis, I have prepared this presentation, and on those terms we'll be talking in this video also. If you have any doubts, you can ask me in the comment section. I'll be happy to answer there. Also, we will only see four of the option Greeks. Those are delta, gamma, theta and Vega. Rio is also there, but I personally feel that it is not so important, and I also have not spent enough time in understanding about it. So let's get started with delta. The price movement of the option position relative to the movement of the underlying asset price, that is delta. So in other terms, delta can be also considered similar to as speed. So speed of an option is determined by delta. So if you take an example, if the delta is 1, means the option position will move 1 point for every 1 point the underlying asset moves. And the typical range of delta in the example, even though I said it is 1, between 0 and 1, and both the boundaries are not included. That means cannot be 0, it cannot be 1, but it can be near to that. So in the ATM, that is at the money options, delta will be of 0.5 for call option and negative 0.5 for put option. So let's talk about another terminology or a strategy dealt with delta. Delta neutral trading concept. You might have heard this in some strategy which is kind of advanced trading for experienced traders. Any position if you take in option with sum of delta close to 0, it is called as delta neutral trading. This doesn't mean this is a risk-free trading, but it is a style that enables profit to be taken regardless of the direction of the market movement. But as I said earlier, this is not easy. Even though the concept is very simple, this is only really suited to professional traders who have a lot of experience and capital for trading. That is the basic explanation of delta. Now let's see what is gamma. It is known as the second derivative of delta. It indicates how the value of delta will change in option position. If delta is speed, then gamma is acceleration. So I think you will be able to differentiate between speed and acceleration, right? So speed is how fast an object is moving, that is speed. And acceleration, what will be the change in speed, that is denoted by acceleration. Both CE and PE have positive gammas. Also deep in the money and deep out of the money options have near to 0 gamma. Okay, that is another concept when we talk about gamma. So this gamma can also be considered as an early sign for the delta to take off. So keeping a watch on gamma is always a good strategy. Now let's see the third one in option Greeks, that is theta, which is always an enemy of option buyers and a good friend of option sellers. We will see why. So it is basically option positions dependency on time decay. And you should know option premium. When we say option premium, that is the one which we pay when you want to buy a call or a put option premium. So that premium is actually time value plus intrinsic value. Okay, intrinsic value is always a positive value or 0 and can never be below 0. That means it cannot go into negative. If it is going to negative in any calculation, then it is considered as 0. So intrinsic value never can be negative. So for a call position, the intrinsic value is calculated as spot price minus strike price. And for a put position, it is strike price minus spot price. Okay, let's see the example here. Theta is always a number. Positive or negative indicates the position taken to understand better. Consider an example where the theta is minus 0.5. In that case, the option will lose 0.5 points every day, keeping all other Greeks the same. That is the basic effect of theta on option position. So in this example, what we have seen is theta is always a number. Positive or negative indicates the position taken to understand better. The example which I have given, 0.5, negative 0.5. So 0.5 is actually the theta value. The negative indicates we are on buy position. So every day when we hold this position of option, we are going to lose 0.5 points. Okay. So if the theta is negative 0.6, that means every day we are going to lose 0.6 points on that option position if we are on the buy side. So if we are on the sell side, then the theta will become positive. That means if we are holding that sell position, then the theta will act in favor of the sellers. Where for the buyers it is losing, for the sellers it is gaining. Okay, so that is the basic understanding of theta. Now let's see the last one in the option Greeks, known as Vega. So Vega is option position influence to volatility. The option value increase when underlying assets volatility increases. The value of Vega is positive for both CE and PE. In theta case, we have positive and negative, but for Vega it is always positive, whether we are in call or put. For example, if Vega is 0.10, then for every 1% change in IV, which is called as the implied volatility, the option price should change by 0.10. That is the explanation on Vega effect on options. So here you might have a question, what is implied volatility? So there are different types of volatility, okay? And implied volatility is one among them. So implied volatility is the expected volatility of an underlying asset over the life of the option selected by the people actively taking part in the trading. So it is their expectation basically. Okay, so when I say here as over the life of option selected, which I basically mean is what is your expiry chosen for that option. So that is the life of option. Okay, if you have chosen 31st of December as expiry for an option, then the life of option will be till 31st of December. We have almost completed the basic explanation of option Greeks, which we discussed here. Now 4 of them: delta, gamma, theta and Vega. So now let's look at the 4 basic strategies with an example on how to take a trade and what could be the option Greeks for those. The first among the list is long call. So if we want to go for long call, we have to choose the strike price. That is the first step. So let's see as a trading example here. Stock A is trading for a price of rupees 5,000. That is the current price of an underlying asset in case of option. 31st December, 4950 CE. That means 4950 CE call option, which is having the expiry of 31st December, is trading for a price of rupees 100. The maximum loss in buying this call option is rupees 100 because this is the option premium or the price of the call option. Okay, so the maximum loss in buying the CE is rupees 100, which is 100 into the lot size, because we cannot take one option, we have to always buy it in lot size. So that will be the maximum loss. In case of Nifty, the lot size is 75. In case of Bank Nifty, it is 25. Similarly, for different stocks, it is having different lot size. That we have already discussed in episode 1. If you have not seen that, please go through that episode 1, which will give you a very basic understanding, which will help the beginners a lot there are few terms described, few concepts described in episode 1, which will give you a continuation when you're watching this episode 2. Okay, now what is the maximum reward? It can be unlimited. These things are also explained clearly in the earlier episode. And the break-even price, how to calculate the break-even price. So it will be the strike price plus the premium what we are paying. That means the CE price. So here the strike price what we have selected is 49.50 call. So 49.50 plus the premium what we have paid is 100. So it is 50.50. So when we are reaching a price of 50.50 for stock A, and if we are in that position on the day of expiry, then we can come out of that long call without making any loss or even no gain also. But you will definitely have a loss in the form of brokerage charge or something, GSTs and all those things. But ideally in this trade example, we are not considering the other parameters or cost. We are only looking at the exact value as MTM. Okay. So 50-50, if the stock A is reaching 50-50 at the day of expiry, then we can come out of this without any loss or gain. But if it is even 1 rupee less in case of long call, even if it is 1 rupee less, 50.49 or even if it is 0.5, okay, anything less than 50-50, if it is even 1 paise or 10 paise, 50 paise, anything which is lesser than that, then the stock is going to be out of the money and our entire premium we will lose it. Okay, so only if it is closing exactly on 50-50 or above that, we will be able to make profit. 50-50, then it is a break-even point. Okay, now let's see the option Greeks. So these are few diagrams. If you are able to understand it, it's well and good. So I thought of explaining this also in the part of this episode. But if you are not able to understand it, just leave it for now. And once you are familiarized with this position, and when you take some live trades, okay, you will be able to understand it more. So delta is the positive. Here in this case for long call, it is positive and increases at its fastest rate around the strike price until it reaches 1 or close to 1. So the delta is also 0 in case of out of the money. Okay, so this is the delta graph. And the Vega is also like this. This indicates the Vega is positive, which indicates the volatility is helpful to the position because higher volatility translates into higher option values. So higher the Vega, it is good for option buyers because the price is going to go up, which is bad for option sellers. In case of Theta, it is different. Okay, it is just the opposite. Theta is a good friend of option sellers and not a good friend of option buyers. It is an enemy. And for gamma, here you can see the acceleration. So it's always positive with long call, and it peaks when delta is at its fastest, steepest rate. That means here in this example you can see here, see it is higher, and as delta is approaching it is the higher value, the gamma is actually going down. So now let's look into the next strategy among the 4 basic strategies, that is a long put. So here also let's see an example on what is the strike price choosing. So if stock A is trading for a price of rupees 5,000 and 31st December 50-50 PE, this is the expiry, this is the strike price of put option, is trading for a price rupees 100. The maximum loss in buying this PE is rupees 100 into lot size. Maximum reward can be unlimited. The break even is strike price minus PE price. That means what is the premium we have given for buying the put option. So it is 50-50 minus 100, which is 4950. So if the stock is coming down to 4950 and staying there at the time of expiry, then we will be in a break-even situation. Okay, even if it is 1 rupee or 0.5 paise above this price, that means it is 4950.5, then also this entire premium whatever we are going to pay will become 0 at the day of expiry. Okay, only if it is exactly reaching this one 4950 or even lesser, we will make, either we will be in break even or we will make profit. Okay, the option Greeks for this long put position is almost kind of mirror imaged. The delta position here, you can see the delta is 0 when the option is deep out of the money. Okay, and the delta here in this case is negative, and for long call it was positive. You can see in the previous slide, and here it is negative. And for Vega, it is the same as long call. It is positive, illustrating that the volatility is helpful for the position because higher volatility translates into higher option values. The same with gamma, the same thing what we have seen in long call. And for theta, theta is negative, illustrating that time decay hurts the long put position, which is similar to long call. And now let's see on the short call. So here the time decay is helpful to your naked sold position, so it take advantage of the maximum time erosion. In the case of weekly options, the maximum time decay occurs from Tuesday till Thursday. Friday and Monday are not so best days for intraday trading with naked short or naked put. Okay, now let's see the option Greeks of short call. Choosing the strike price. You can choose out of the money strike price for short call, and the expiry, if you are going for long trades, it can be a month or less would be ideal, especially when you do shorting of options. So if you see the other way, for buying option on intraday, Fridays and Mondays would be the best day. Okay, that doesn't mean that you cannot make loss in that. You can make loss there also. The risk is there even if you buy option on Friday and Monday for intraday, but comparatively the time decay factor is less on Fridays and Mondays. Okay, now let's see an example here for short call. If stock A is trading for a price of rupees 4950, 31st December 50/50 PE, this is the expiry and this is the strike price of put option, is trading for a price rupees 15. The maximum loss in shorting the CE is unlimited, because why we have explained why this unlimited, we have explained in episode 1. Please check that, you will get a more clarity on this part. And the maximum reward can be rupees 15, which is the premium what we are getting it. And the break even is strike price plus the call option price, that is the premium what we are getting it. So the strike price chosen here is 50/50 plus 15, which is 50/65. So until that, if the stock price moves until this point on the day of expiry, we are not going to make any loss or gain. And let's see the option Greeks here. So delta is negative and moves at its fastest rate around the strike price until it reaches -1. So the delta is 0 when the option is deep in the money, okay, or deep out of the money. Similarly, the acceleration you can see here, and the theta, which will be positive, because in case of shorting options, theta will be in favor of sellers. Okay, and volatility, the Vega factor, which is not so good for sellers. And let's see the last one among the 4 basic strategies, which is the short put. Here also the stock A, let's look at the trading example. If stock A is trading for a price of rupees 5,000, 31st December 4950 PE is trading for a price of 50. Maximum loss in shorting this PE is unlimited. Maximum reward can be rupees 15. The break even is strike price minus PE price. So here the PE price is 15, which we are getting it, right? So 4950 minus 15, which is nothing but 4935. Until this point, we will be break even. And if the option price is going above the 4950 mark, because when we do shorting of put option, that means we have to be bullish on that stock. In that case, we will do shorting of put option. In case of shorting of call option, we are expecting the market to go down. So these concepts are explained in episode 1, so I am not briefing on that. If you watch that and come to this episode 2, you will get a better clarity. Okay, in this one, I just want to give how you can take a trade on these options, and what are the option Greeks, how it will affect. So it is just a refresher to the episode 1 with some more insights with few examples also. And that's all for this episode, and I will show you for next episode what I have planned. I have income strategies, around 12 of them, and this one we will be seeing 3 each on every episode. So next 4 episodes we will cover the income strategies. So stay tuned. If you have not already subscribed to the channel, please do subscribe and share the video with your friends and colleagues who are into trading, and better that will help the channel also to grow, and which will be a motivation to me to make more and more videos of this kind. So please help the channel also by subscribing. Thank you for watching. Have a nice day. Bye bye.